Hello and welcome to the third and final walkthrough video for chapter 14. I just have one more problem that I need to show you, and I think this one is really short. This video will be really short, but it really does align better with the third lecture video, which is why I did it as a separate video. And that's the problem on discount on notes payable. So the entire chapter discussed bonds. We spend a lot of time on bonds, but that's not the only thing in this chapter. We also talk about notes payable because the whole chapter is supposed to be about our liabilities. So we've seen discount on notes receivable. This is just the flip side of discount on notes payable when we're dealing with a zero interest bearing note. It's just that this time, instead of someone borrowing the money from us, we're dealing with a notes receivable, we are borrowing the money from someone else. So let's specifically look at brief exercise 14.10, and that's on page 14-37 in your textbook. Now, let's see if I can actually see this today. Coldwell Inc. issued a $100,000 4-year 10% note at face value to Flint Hills Bank on January 1st, 2020, and received $100,000 cash. The note requires annual interest payments each December 31st. Prepare Coldwell's journal entries to record the issuance of the note and the December 31st interest payment. So for this specific problem, I like this one because this one isn't just a zero interest bearing note because there are actual interest payments. And unfortunately, I told you I was only going to do one with you, and I was wrong. I'm going to do two because I forgot that this one, I may do one, or I may save this one for you to try on your own. I can't make up my mind. But for this one, I know that this is not a zero interest bearing note because there are actual interest payments that are made. So let me go back. I'm using my same document here, my same Excel spreadsheet. But I want to paste, so the copy and paste so that I can have my same formatting. And I make it bigger so that you can see it. All right, so what the heck are they asking me to do here? I have no idea. I forgot already. I have to prepare the entries for the issuance of the note and the December 31st interest payment. Okay, I should be able to do that. So on the day the note was issued, when you borrow money, you get money. So we're going to debit cash for the full 100,000, not 10,000. And plus, this problem told me that we received cash, so we know what to do for half of it already. North. So the credit goes to not North payable, but notes payable. Don't know what's on my mind here. Record issuance of notes payable. Pretty straightforward. Now, the next thing that we have to deal with is the annual interest payment that happens at the end of the year. So we don't even have a discount for this one because the note was issued at face value. This is no different from what you learned in Accounting 1, but I've recognized that Accounting 1 was a long time ago, so you may not remember that, but we get cash, we credit notes payable. Then at the end of the period, using the same interest calculation that we've been using all chapter long, we take the principal amount of the note or the face value of the note, and we multiply it times the interest rate, which was 10%. And I don't have to multiply it times a half because we only make these payments once a year, which could in effect happen. So I'm canceling out my zeros here, and I should come up to, I probably didn't cancel out enough zeros. We'll find out when I do the calculation here. 100,000 times 10%. And I knew it. I didn't cancel out enough zeros, or I canceled out too many zeros. 10,000. So we record the interest expense and we credit the cash. So in the real world, a lot of loans are formulated so that over the life of the loan, the interest payments are made, but the principal payment, there's one principal payment, and it's made at the end of the life of the loan. Sometimes the loan could be structured so that there are equal payment amounts and there's a different amount of principal and interest that's being paid each time. So the loan arrangements could vary. More often than not, what we see in the real world is, and what we see with our own personal bills, are that we pay a different amount of interest and principal each month. The total payment may be the same, but in most cases, the amount of principal and interest that we pay will vary from period to period. Now, let's do brief exercise 14-11. And if I happen to assign that for you for homework, I don't remember. You can take it as a freebie. But we have to do 14-11 because that 14-10 was just way too easy. So let's do a harder one. And hopefully this one is harder. All right, brief exercise 14.11, same page here. This time we have Samson Corporation issuing a 4-year $75,000 zero interest bearing note to Brown Company on January 1 and received cash of $47,664. The implicit rate is 12%, and we need to prepare the entries for the issuance and the recognition of interest. So again, let me go back and copy and paste so that I can have my nice formatting that I like. It doesn't drive me nuts. And I can delete that. All right, so for this one, we have a zero interest bearing note. That means there are no cash interest payments. The interest is implicit in the note. So what that means is the amount of cash that we get today is going to be a whole lot lower than what we have to pay back. And we know that this is true because the note is for $75,000, but we don't get $75,000 in cash. We get $47,664. So again, let's attack this entry by dealing with what we know. On 1/1, I know I'm getting cash because the problem explicitly said we're getting cash at $47,664. Now, I also know that the value of the notes payable, what's going to have to be paid back, is this $75,000. Of course, my entry doesn't balance. The difference represents my discount on notes payable. My discount on notes payable is a contra liability account, very similar to discount on bonds payable. So we know how to deal with this now. It's just the difference between my cash and the principal amount of the note. So I want to make sure that, let me do it the right way. Let me do it with the formula. This minus this. 27,336. Now, when we record interest expense, because there are no cash interest payments, interest expense will solely reflect or represent the amortization of this discount on notes payable, because at the end of the life of this note, the carrying value has to be equal to that principal amount. So we have to slowly eat away at this discount on notes payable. And for this one, we'll pretty much use the effective interest method here. So on 12/31, I'm not going to record a cash interest payment, so no credit to cash, but I do need to record some interest expense. The other piece that I need to record is the amortization or the reduction of discount on notes payable. So we're going to credit discount on notes payable. Now, I am told that the implicit rate on this note is 12%, or am I making that number up? Nope, the implicit rate is 12%. So I'm going to take that 47,664 and multiply it times 12%. So again, I'm using the 47,664 because that is the carrying value. So we're using that effective interest method again, like we saw with bonds payable. And that's going to give me my amount of interest expense. Now, if you include the pennies here, and I'm not, because last time I did, and I ended up wasting a lot of time, you're probably going to get 57, I think 19.68. But you can round it up to 57.20. So that is the amount of interest expense. Now, when we did this before, when it is a short-term liability, we don't have to use the effective interest method. We kind of ignore the time value of money implications there, so we're not really using that effective interest method. But because this is a 4-year note, we're going to use the effective interest method, and that's when we're going to take that carrying value. Rather than taking discount on bonds payable and just dividing it by 4, we're going to take that carrying value and multiply it times 12% to find the amount of interest that we need to record. So this takes care of the video on dealing with notes payable. Very similar to the way that we deal with bonds payable. We can have a discount on bonds payable. We can have a discount on notes payable. We can have a premium on bonds payable. We can have a premium on notes payable. All of it is still debt. The primary difference between a bond and a note is that a bond has multiple lenders, but a note only has one single lender. I appreciate your time and attention, and I hope you have a wonderful day.